Business deductions are full of traps because the label sounds right, but the tax treatment isn't. On the EA exam, they love asking whether something is currently deductible, must be capitalized into basis, or is deductible somewhere else on the return. In this lesson, focus on 4 big trap zones: property taxes versus assessments, business bad debts and later recoveries, insurance with special health insurance rules by entity, and business interest versus investment interest. Start with taxes on real property. Real estate taxes are deductible when they're based on assessed value. Think ad valorem property tax. But assessments for local benefits and improvements are not currently deductible. If the city charges for sidewalks, streets, sewer lines, or water mains, that's a basis increase. The sneaky exception: if part of the bill is for maintenance, repairs, or interest related to the improvement, that portion can be deductible. Bad debts are a classic accounting method trap. A business bad debt deduction generally requires that the amount was previously included in gross income. That's why accrual method businesses can deduct uncollectible receivables. They already picked up the income. Cash basis businesses usually cannot deduct unpaid customer invoices because they never reported that income in the first place. Another path is a true business loan that becomes worthless, but it must have a real business purpose. Now the follow-up they love: later recoveries. If you deducted a bad debt in a prior year and later collect some or all of it, you generally include the recovery in income in the year you receive it. You don't amend the old return. This is the tax benefit rule idea in action. You got a tax benefit from the deduction, so the recovery is taxable when it comes back. Insurance premiums are usually straightforward. Ordinary and necessary coverage for the business is deductible. Think property and casualty, malpractice, business interruption, credit insurance, workers' comp, and group health for employees. One exam trap: vehicle insurance is not separately deductible if you use the standard mileage rate, because insurance is baked into that rate. If you use actual expenses, then you can deduct the business portion of insurance. Health insurance is entity-specific, so memorize the pattern. Sole proprietors don't deduct their own health insurance on Schedule C. It's an adjustment to income on Schedule 1 of Form 1040 if they qualify. Partnerships typically treat partner health premiums as guaranteed payments. S corporations can deduct premiums for more than 2% shareholder employees, but they must also include them in the shareholder's W-2 wages for income tax withholding purposes. C corporations generally deduct employee health premiums as a regular business expense, even if it creates a loss. Finally, interest. Business interest is interest paid or accrued on debt you're legally liable for, when the debt relates to operating the trade or business, buying inventory, equipment, or keeping the doors open. Don't confuse that with investment interest. Investment interest is tied to borrowing to buy taxable investments, and it's generally an itemized deduction limited by net investment income. On the EA exam, the use of the loan proceeds is the key fact. Ethan is a self-employed electrician filing Schedule C. During the year, he pays several fines and penalties. Which one is deductible as a business expense? A speeding ticket while rushing to the courthouse, a parking ticket while visiting a client's worksite, penalties for late performance on an electrical maintenance contract after the client took him to court, or penalties for paying his federal income tax late. Think about it. The deductible item is the penalties for late performance under the business contract. That's basically damages paid to a private party, and it can be an ordinary and necessary business expense. The tempting wrong answer is the parking ticket at the client site, but fines and penalties paid to a government for violating the law are not deductible, even if you were doing business. Marisol is a cash-basis sole proprietor with a bookkeeping firm. This year, she performs $1,000 of services for a new client, but never gets paid. Which statement is correct? She can deduct it as a non-business bad debt on Schedule A, deduct it from gross income, deduct it on Schedule C as a business bad debt, or she has no deductible bad debt. Think about it. The correct answer is that she does not have a deductible bad debt. As a cash-basis taxpayer, she never included that $1,000 in income, so there's nothing to write off. A common trap is calling it a business bad debt, but uncollected fees for services aren't deductible for cash basis businesses unless there was an actual loan of cash that became worthless.